Good morning, everyone. Well, yesterday's good news for the dollar, which was a higher than expected retail sales in December, took some time to sink into the market, but eventually the market looked beyond the lower headline number to the higher core figures, such as the one excluding autos and gas stations, and those reassured investors on the economic outlook. A higher than expected number on business inventories in the U.S. didn't hurt either. As a result, Treasury yields rose, implied interest rates on the Fed funds futures rose, and the dollar gained against most currencies. This morning it's higher against most of its G10 counterparts, especially the Australian dollar and the yen, and lower against only the Scandies and the pound. Now, the rally in dollar-yen is understandable given the strong rally in Tokyo stocks this morning, since dollar-yen tends to move in line with Tokyo stocks. But the dollar's gains against the Australian dollar need some explanation. With short-term rates probably frozen for some time in both countries, Aussie dollar seems to be driven recently more by interest rate differentials at the long end of the yield curve rather than the short end. As U.S. Treasury yields rise, narrowing the spread between Australian and U.S. bond yields, Aussie dollar tends to decline recently. This is one reason why I expect the Aussie dollar to remain weak for some time, as the government there appears to be in no rush to raise rates, while on the other hand, I think the market's underestimating the likelihood that the Fed continues to taper off its bond purchases at a regular pace. Yesterday, both Philadelphia Fed President Plosser and Dallas Fed President Fisher both came out in favor of more tapering. It's now 4 out of 4 FOMC members who've spoken since last week's disappointing payrolls data and said they remain committed to tapering. So I expect that the FOMC will continue to do so at the meeting later this month. That should support the dollar further, in my view, especially as against the Aussie dollar as the yield spread there narrows further. Meanwhile, the rally in sterling was quite impressive. Even yesterday's further decline in inflation in the UK didn't delay it for long. On the other hand, the Canadian dollar weakened, even though oil had a good day, and the Toronto National Bank Home Price Index showed that the rise in house prices accelerated in Canada in December. So the positive trend for sterling and the negative trend for the Canadian dollar both seem to be intact, and I reiterate my suggestion to look at sterling Canada. Today, the only important indicator coming out in the Eurozone is the trade balance for November, which generally isn't market moving. Later in the day, in the U.S., the Empire State Manufacturing Survey is forecast to have risen in January, or to rise for January. And the U.S. PPI for December is also expected to show some acceleration in price increases. A rise in the manufacturing and a rise in producer prices is likely to support the dollar. Also, the Fed releases its Beige Book survey 2 weeks before the FOMC meeting. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.